Very good afternoon. You're watching the newsroom right here on ET Now. I'm Ajay Sharma. The markets are in good fettle. In fact, some support from the market is also from the global cues also helping. And look at that, 17,550 is where the Nifty is trading at days high. Good data from quarterly updates is also helping. The bank Nifty as well. HDFC Bank IndusInd saw very good quarterly updates on deposit on trade growth, and that's the bank Nifty for you. Rebounding from the day's low, now at sessions high. So buy on dips clearly seem to be emerging even at these levels. We've got Vinay Jaising joining us on the show today. He looks after the PMS and AIF business at JM Financials. Vinay, afternoon, and thank you so much for coming on our channel today on my show. Let's start by getting your thoughts on some of the global indicators, how they're shaping up, because that's what is responsible to a large extent. For example, we saw Q4 GDP, US Q4 GDP coming in softer than estimated. Then the ISM data was softer. The PCE data was softer. Does it give a sense to you that the data, the engineered slowdown, and because of higher rates, liquidity issues in select banks, all of that is now leading to perhaps it may hold the hand of the Fed going forward. So data has turned supportive in that direction, and that is what global markets are also cheering.
So I think you put it very well. Sometimes not good news is news for the overall market, and I think that's what's happening. Had we not got a weaker GDP, you probably would have seen much more rate hikes coming from US. Had the inflation levels in US not been as resilient, you would have seen bigger rate hikes coming in. But now the expectation of rate hikes in US is at best one more, at best a 25 basis point, and in the second half of the year, actually, you'll start seeing rates come down, which in a way means that the higher for longer interest rate cycle would remain, but the definition of higher would be high for longer. And that I think is in the short term not good news for the market, which would be a quarter or so. But when you start seeing the interest rates fall, the markets will be smiling again. Just one more parameter, if you look at commodities, though oil has gone up to probably $85 a barrel, gas is at $13 an MMBTU. Gas prices are down to probably one-fourth to one-fifth of its peak. So power costs world over is coming down, which is another good sign, very good sign for Europe. So non-US, you're seeing a lot more positive news come up already, which I think, apart from the banking crisis, which we are dealing with in US, is leading to much better stabilities, and the volatility in the market after a quarter should be much less.
Vinay, what does all of this mean for markets like India? When the world was in a kind of a crisis, we were standing tall. But last few weeks, we've seen a major rally in other emerging markets like China, Taiwan. India did not participate. Global rally also, India did not participate. Also, all these macro indicators which we discussed, how does that translate for Indian markets?
So thank you for this question again. If I were to look at Jan 2022, FIIs had as much as probably $620 billion in India, about 21%. The currency was 74. Today, the currency is 82, and the Indian markets have virtually gone nowhere. As you put it, 17,500. Jan last year, it was about 17,100. So you've seen a tepid growth, and a lot of it come in the last 3 to 4 days. In that same time period, the global markets have done relatively in line with India, though at a period of time India had outperformed the market purely in the year Jan 2020 by as much as 9 to 10%. So the year 2023 for India has been an absolute miss as far as equities are concerned. You've seen the global Nasdaq going up 13 to 15% and MSCI India going down 3 to 4%. So you've seen a 15 to 18% devaluation of the Indian market itself. So the froth which was there in the market, or the valuation which was at 110% premium to MSCI EM or 50 to 60% premium to MSCI World, that has come down to as much as 60% as far as India is concerned to EM, and about 20%. So that will probably in the second half of the year give a lot more stability to the Indian markets as far as inflows are concerned. And also the earnings resistivity of India is pretty good. So I think India is getting into probably one quarter from today into a buy zone territory as far as we look at it.
Okay. Acha, what about the valuation angle from earnings potential point of view? Because just yesterday we saw Asian Development Bank, World Bank trimming India growth estimates. In fact, Axis Bank also on a public platform said that growth will start impacting the Indian ecosystem as well. If that indeed happens 12 months from here on, then will that softening in growth not translate in lower earnings? Has that adjustment been done with the market, or it is yet to be done?
So again, one of the key risks which we see in the world is when interest rates are high for long, you'll see world earnings go down. Part of it has already happened. The remaining part is left. But let me take you through the curious case of the Indian market. Why do I use the word curious? Is the index earnings come a lot from the banks, and the financial sector is probably in a so-called Goldilocks scenario, wherein you're seeing the overall loan book growth at north of 15%, and deposit rates, though they are going up, the absolute deposits are also increasing. So there is liquidity relatively into the system which is already there. So if 40% of your earnings for India and the index weightage is about 30%, if these two, if you multiply, 10 to 12% is just the index growth coming in from the financial sector for the next year itself. So if the remaining 70% of the index even contributes 4 to 5%, you probably will see the country at 10 plus 5, somewhere close to 15% earnings growth, which will probably be 2.5 times that of the rest of the world. So if we are concerned about Indian earnings getting corrected, our concern for the rest of the world would be amplified multifold times. So I think India is a lot more resilient, courtesy the banks as far as earnings are concerned, and a lot of that pain as far as the index movement is concerned has happened. Remember, if we did this call a week ago, the market was sub 17,000, and then you've seen some liquidity and the markets corrected. People thought it was an NAV effect, but even post April 1st, the market's moving up pretty well. So I think buy on dips is a clear indication which we are telling investors. Valuations are not as expensive. We are smack on the last 5 year average of of about 20 times P. Earnings are looking resilient. But remember, if you go forward by 1 year, which is if you today you're sitting in April 23, when you go to April 24, you're probably at 16 times F25 numbers. And in a couple of months, all the analysts will start using F25 numbers because F23 is over. Then valuations will look relatively a lot more attractive.
Vinay, how are you structuring your portfolio? What's the portfolio approach you're taking at your end right now?
Sure. Thank you again. I think we are breaking up our portfolio into three themes. Theme one, which is interest rates being high for long, and that's where we're very excited banks. At the same time, we are avoiding spaces where the leverage is very high because when interest rates are high, interest costs would also be high. So you're better off playing delivered companies. So that's theme one, and that's where we like private banks and public banks as well. The second space, what we really like is the capex story. In the budget, the government had announced the overall capex for the country going up from 4.1% to 4.9%. And that we are seeing already, both from corporate but also from PSUs. The capex is increasing, and hence we are excited the capital goods space. And the third space where we are bullish about is the Make in India story, especially in those spaces like specialty, chemical, or defense, wherein you're either replacing the global markets demand which was coming into the country, or wherein you have just India having the forte to be able to produce those chemicals and sell it to the rest of the world, which is not existing anywhere else.
Vinay, what are your thoughts on the mid cap and the small cap end of the market? And what percentage of your portfolios will be falling in that bracket? Because that end of the market has already seen a very brutal correction for last 15, 18 months. Does that offer good value? Is the froth out? If one makes in the next 3, 4 months, a good basket from there, including mid cap, small caps, is it good to expect good returns in the next 18 to 24 months?
So I think selectively, if you are doing active ownership of stocks, the answer is yes. Most of our Make in India stories are in the small cap and mid cap range, especially specialty chemical names like Archean or Gujarat Fluoro. But when we are talking about banks, most of the banks come in the large cap category. So for us, 60-40 is a good mix, with 60 being for large cap and 40 being for mid cap and small cap. Today we have almost 10% of cash. Part of it we deployed last week. We were a little lucky. We got the market moving up, so we got some alpha out there. But we've kept this 8 to 10% of cash for any corrections. We would be buying on dips. There are lots of good mid cap and small cap names in our portfolio. We are excited of. I mentioned specialty chemicals, but even in banks, you've got some names like Fed Bank, which look exciting, as well Karur Vesa. Also, you have some names in the capex story, which look very good, which come into the small and mid cap category. Companies like MTAR.
Right. All right, Vinay, we'll let you go on that one. Thanks so much for joining us with your view on the markets and your sharing your portfolio strategy. Vinay Jaising
Thank you.
from GM Financials. Time for a very short break.